Good evening, everybody. Hope you're doing well. Raza Khan here. It is a beautiful day in San Antonio. Today is Wednesday, the 17th, and we have a lot of exciting updates to share with you today. We're gonna be kicking it off in about a minute, 2 minutes. People are joining. We usually start about 2 minutes, later. It is 7 o'clock, and I'm gonna put myself on mute, get some water, and I'll be back in exactly a minute, and we'll kick it off shortly thereafter. Look forward to talking to you. Look forward to sharing some exciting updates with you, and thank you for joining once again, Raza Khan from Qila Capital. I'll be speaking to you shortly. Hey, everybody. Welcome one more time. Raza Khan here from Qila Capital. It's a beautiful day here in San Antonio. We're at the Qila Ranch. The weather is finally cooling off. We got some animals here, a couple of horses running around. So if you hear any sounds in the background, please excuse me. But I figured, you know what? The weather's lovely. I might as well sit outside today and do this. So we're very excited to share some updates with you. Today's agenda is very straightforward. We're going to try to keep it 30 minutes long and not more. I know time is valuable. It's dinner time, past dinner time in the East Coast. So right now, 7:01. We're going to kick it off in about 30 seconds. The agenda for today is the following. We're going to talk about a couple of updates on what's happening in the market, macroeconomic view. We're going to talk about, why hospitality and why investing in hotels is the best choice in 2025 compared to all the other alternative investments that are out there. And lastly, we're going to touch on the opportunity right now, which is the Aloft Hotel acquisition in San Antonio at the San Antonio airport. And we'll leave the last 5 minutes for questions and answers. If you have any questions, please save it. And there's a little button at the bottom there that says QA. And you can type your question and I will get to them towards the end of the call. At this time, I will share my screen and we will go from there. Thank you very much for joining us once again. We try to do these webinars once a week or, once every few days, on different topics. Today is a bit of a blend on everything that's going on, macroeconomic view and sort of a zoomed in view on the opportunity itself. Okay. I'll be sharing my screen and I'll be walking you through the slides. So please save your questions till the end. So before we begin, our company is Qila Capital LLC. This is a company pursuant to the 506C Regulation D of the Securities and Exchange Commission rules, etc. Our offerings are only open to accredited investors. We're registered with the SEC. We've all gone through extensive background checks. But of course, if you're here, you're probably an accredited investor, and I may have spoken to you in the past. Moving along, the agenda is 20 minutes for the presentation, 5 minutes for the Q&A. That should conclude, set us on track to end this webinar within 30 minutes. So we'll talk about what's happening in the market right now in commercial real estate. We'll talk about the multifamily mediocrity. That's what I call it. And, we'll compare hospitality to multifamily, which is the biggest asset class in the nation. And we'll talk about the Aloft Hotel, which is our current offering at the moment. And then we'll leave about 5 minutes for Q&A at the end. So welcome to Qila Capital. Our company, we are a company with a very conservative approach to investments. We like to think of ourselves as the fortress for wealth preservation. So the word Qila in multiple Eastern languages means fortification or fort. And we like to be a similar kind of, we like to have a similar concept when it comes to wealth preservation for our investors. We have over $100 million in assets under management in our current portfolio. And that does not include money that we raised through the fund. This includes liquidity between the partners and some other private investors that we have. And our portfolio consists of two different asset classes. So one of them is healthcare because it's truly a recession-proof asset class. Secondly, it's hospitality because it's another fantastic industry backed by real demand, and we'll talk about that in a moment. So our mission is, to safeguard your life's work, right, and put your nest egg to work and give you consistent and reliable returns without any unnecessary risk. And you'll see that in our approach and how we're modeling our current offering in a moment, and we'll talk about that momentarily. Let's talk about what's happening in the market right now. So we are still coming out of what I like to call it a pandemic hangover. This is a term that I coined, and you can use it if you like. What does that mean? That means that we went through a severe black swan event, and the interest rates were very low, and asset prices were very high, and a lot of asset owners, they refinanced their commercial assets at very low rates and high valuations. And they did that using the CMBS loan, the non-recourse loan, which for people that don't know too much about commercial real estate, it is the commercial mortgage-backed security, similar to what happened in 2008. So what we're noticing now is that there are a lot of assets that are distressed just because the owners were overzealous and they purchased more assets. They could only service the debt at low interest rates. Now the rates have gone from 2.5%, 3% to 7.5%, 8%. And they cannot service that debt anymore. So they're just giving the keys back to the lenders, and the lenders are selling off assets. This is very common in different asset classes, but not so much in multifamily, in hospitality, which we'll talk about in a second. It's especially high in office at the moment. So the rates are high, but yet the economy is still booming. That's another interesting little scenario. A quick little update. Today, the Federal Reserve lowered the Fed rate for the first time in 2025. We're not banking on that too hard. I believe personally, and this is my opinion, you can agree with me or disagree with me. I believe we're in a bubble right now, especially the S&P. The S&P just hit an all-time high again. If things don't make sense, okay? The rates are high, but the economy is doing really good. The unemployment rate is really low. The S&P and all these AI companies, I believe we're in a bubble and there's going to be a correction, but I'm not an economist and I'm not a CPA. I'm not a financial advisor. This is my opinion, okay? Some macroeconomic policies have changed recently. Of course, the one big beautiful bill just came out under President Trump, a couple of months ago. This is his benchmark economic policy. The rates are, the taxation has been affected for investors, for W-2 earners, etc. And if you think this affects you, please talk to your CPA. And if you want to pick my brain about it, I'm happy to do that. I can get on a call with you and discuss it with you, or you can ask me a question. Of course, there's a lot of FDI coming in, a lot of jobs being created, and so the administration claims. We don't have any real data on that yet, okay? Tariff inflation is hitting home. We know that tariffs are being implemented for a lot of different economic partners, China, Canada, the European Union. But we don't know, economists say that is being passed on to the consumer. The White House claims that it's being, passed on to the countries. We don't know, but what we do know is that the inflation is going up a little bit, right? Which is the release. And, this slide, I made this deck last week before the Fed announced the cut, and this literally happened today. So this part right here, the update, I just added this 10 minutes ago because I was predicting something would happen, and it did. So that's good news that the Fed has lowered the rate. Hopefully that's going to help things. Now, what I talked about earlier, the CMBS data, this is a chart that is created by a big data company called TREP, which monitors what's happening in the world of commercial real estate. This shows you the different asset classes like industrial lodging, which is hotels, multifamily apartments, office, and retail, it shows us what the delinquency rate is like currently. As you can see, the worst, it's high. Overall, the worst asset class right now is office. We all know that. The delinquency rate went up. It peaked during the end of the year last year, which makes sense because it's a calendar year, but it's going up again, right? But you'll notice that hospitality, which is lodging, the yellow one, is actually trending down. That's what we're finding also, that this deal that we have right now, the Aloft, and we'll talk about that in a moment, we have a really good deal on this, and we have it under contract at a really good price, between 30 to 40% below replacement cost, at a 2.5 times revenue multiple. And when we were looking for deals, we saw some deals pop up here and there, but we're not seeing that anymore. So, because we're looking for more deals to add in the pipeline. So a little interesting statistic that I thought I would share with everybody. Moving on, let's talk about why hospitality beats multifamily. So I'm focusing on multifamily because it is the most saturated asset class. If you're on Facebook and Instagram, if you saw us through our ads, you'll notice that we're one of the few companies that are promoting hospitality, but most other funds out there are still promoting multifamily, which makes no sense to me because it's super saturated. The cap rates are very low. And I don't know how they can deliver dividends in this economy when the rates are so high, right? So anyway, we're not going to talk about them. We're going to talk about us and what we're doing here. Why is hospitality the best asset class in 2025? So leisure and bleisure travel remain strong. So bleisure is a new concept that wasn't around before. As people are working from home and they can work with their laptops, especially the affluent people, they're traveling and they're working, and they're traveling and they're working. So that really supports the demand for hospitality, for hotels. And leisure, Americans are traveling more than ever before, especially the extended stay hotels. They do really well. During COVID, the portfolio that we have in place, my partners, they've owned 3 hotels. And all 3 hotels currently, the ones that we have in place, they did phenomenally well during COVID. They did not have any issues in terms of, revenue going down or profit going down. As a matter of fact, they were booked up because traveling nurses were traveling, and some corporate accounts like the National Guard, etc. So that's number one. Number two, select stay and select service hotels, they outperform full service. What we're targeting the 3-star hotels, the select service hotels like the Courtyard or the Aloft or the Hamptons Inn. These are the type of brands that we're targeting, where there's no full kitchen and there's no extensive restaurants, etc. It's for people, they come in, they get a nice, decent place to sleep for a few nights, fresh linens, clean atmosphere. They get a gym, they get other amenities if they wish. And that's all we're targeting. And these are highly profitable hotels compared to any other asset class. And we'll talk about it in a moment. Institutional capital is flowing in. Another phenomenon that we're noticing is that Wall Street, they pounced on, single family housing, multifamily housing, office for a long time. But hotels was one of the only industries or asset classes that wasn't dominated by the institutional capital, like the pension funds, etc., from Wall Street. However, that's changing now. What that means is the demand goes up. There's more players in the market. And it means that we can always exit at a profitable rate later on because it's backed by demand. And lastly, higher cap rate means better entry points. Multifamily and industrial cap rates have compressed. Of course, that means that they've gone down, meaning that the yield, like the profitability, has gone down. People are willing to pay more for apartments. But for hotels, that's not the case, because hotels are not traditional real estate. It is underwritten like a real estate, but it is a full service business. It's a fully operational, fully hands-on business. It requires a general manager. It requires staffing, dealing with people's issue, people calling in sick, and really managing and focusing on the guest experience. So that's the thing. It's a business. It's underwritten like real estate, but it's a business, and because of that, it's more profitable. Lastly, and we'll talk about that in the next slide, is hotels bring a lifestyle opportunity for investors that nothing else brings, other asset classes. What does that mean? That means if you invest in a Marriott property, we have the ability to give you discounts on the Bonvoy program, meaning you could be seeing 70, 80% off, up to 70, 80% off your stay, and travel the world and take advantage of over 10,000 Bonvoy properties around the world at any destination that you like. One of our investors has reached out to us with a strange request, which is interesting. There's a hotel in Africa, I think in Kenya, and it's a safari hotel. It's a Ritz-Carlton, but it's a safari. It's located on a reserve where there's lions and cheetahs and stuff. So imagine taking advantage of that lifestyle angle that you can only do that with this and nothing else while making amazing returns. And we'll talk about that in a moment. So why is it the best? To summarize, you get cash flow on day one. We're not building anything. We're not buying land and asking you to invest in an opportunity where we're going to be building a hotel. We're only investing in hotels that are operational and turning a revenue from day one. There's historical data. There's a P&L. If you want to see it, I can send it to you. The hotel that we're trying to buy right now, the Aloft, did $4.2 million in revenue last year. Okay, it's operational. It's operational right now. I actually stayed there, a few weeks ago, and I recorded a video. Maybe you've seen it, maybe you haven't. I'll send it to you anyway after this webinar. And that's one of the big advantages, that our investors, they get cash flow right away. In the first quarter, they'll get a distribution. Number two, appreciation. Because hotels are a hybrid of real estate and business, and in real estate, when you bring up the net operating income, when you make the hotel more profitable, the value of the asset goes up. Similarly here, if we manage it better, and we know we're going to manage it better because it's a distressed sale, it's not being run right now, and we have a plan on what we're going to do to streamline it and operate it better, we know the value is going to go up. In addition, over the next 36 months, we're going to be doing some what's called a property improvement plan. We're going to be updating the hotel to keep the Marriott franchise, the flag. And that includes new furniture, new carpets, new branding, all that stuff. And it's required by the franchise agreement. When we do that, the value goes up as well, because the average daily rate goes up all of a sudden because it's a more modern and freshly renovated hotel. So that's another thing. Third thing, recession resilience. As I talked about, hospitality aligns with our commitment, which is that we only want to invest in bulletproof, recession-proof sectors. Hospitality, especially the hotels that we target, are within that criteria. So, for example, 2 of our 3 hotels right now have National Guard contracts. One of them has 70 rooms that are being taken up by the National Guard in Laredo. All right. And as you can imagine, that's amazing. The government is the best client to have because they always pay their bills on time. They never run out of money. And, especially with the Trump administration's focus on bolstering up the military, our hotels that we target take advantage of that. And we'll talk about that in a moment, how this hotel will take advantage of that. Lastly, lifestyle benefits, which I just talked about. If you're a traveler, if you're retiring, you want to take more trips with your wife, a lot of people, if you're an accredited investor, you're probably not going to do this to save money. You're probably going to be doing this to stay at better properties. So imagine now you could stay at the Ritz-Carlton for the same amount of money that it would cost you to stay at a Sheraton or a Westin or a Marriott. That's the difference. And that's the lifestyle angle that is truly unmatched, and no one else is doing. I believe no one else is doing what we're doing, what we're offering. Maybe I'm wrong, but I did do some research, and there's not a lot of hotel companies or hotel fund managers like us who are offering this benefit to investors. So what makes us unique? We have a proven track record. We have over $100 million in assets under management. That includes 2 freestanding ERs in South Texas. It includes 3 hotels. We have some other assets as well that we don't really talk about that much. We have 1 multifamily project. We have a car wash. We have a medical spa, which is a lifestyle. it's a spa for I forgot the correct term, but it's a spa for longevity and et cetera. And we're expanding that as well. So number one. Number two, proven strategy. So we have a strategy which is cash flow first. We don't want to touch something that is not cash flowing, but it may cash flow one day. We don't want to do that. We only want to pick up hotels or pick up assets that we know can safely deliver our investors their preferred distribution. And another amazing thing that we're doing, and a lot of fund managers don't do this, is we have no fees of any kind. Okay. We have no acquisition fee. We have no asset management fees, nothing, no administration fees, no exit fees. We are funding everything, the operations of our company, out of pocket. We're treating it like a business that we're growing, and we're putting money into it, marketing, all that stuff. All of that is funded by the partners, not by the investors. And I cannot say the same thing about all the other funds out there. If you look at the PPM, you'll see. Number three, investor first approach. So we work with investors, accredited investors. We have a very generous preferred distribution package that we pay, which we'll talk about in a moment. Innovation driven. So everything that we do is self-directed. There's a portal that our investors can invest through. They have full visibility, full transparency. And we are in this to disrupt the industry and change the game because we want to provide amazing value to investors. That's why we're here. Okay, moving on. This is what our leadership team looks like. We have 3 partners, including myself, Kuldeep Gyani, Dr. Pareen Shah, and myself. And then we have other staff. We have over 50 years of combined experience, a lot more than that, frankly speaking. That includes fund management and includes operational excellence and really turning properties around, finding the right properties, paying distributions to investors, etc. And I don't want to get into take up time and talk about ourselves because we want to talk about the opportunity a little bit more. But if you like it, you can get on an individual call with me and I'll be happy to walk you through it. What does our portfolio currently look like? So we are located in Texas and South Texas, primarily San Antonio and below, and San Antonio and surrounding area. Our office is located just right outside of San Antonio in a town called Bernie. But we stay within the South Texas region because we believe this is the best place to be. People often overlook South Texas. People flock to Dallas or Houston or Austin. We stay away from those places. We stay towards what we're good at, which is South Texas. Okay, San Antonio, Laredo, McAllen, Brownsville, Austin. So some of the properties or some of the assets in our portfolio, the Laredo Emergency Room, current value $47 million, as confirmed by a recent quality of earnings report. We have the Staybridge Suites by IHG in Laredo. This hotel has an average occupancy of over 90%. I would even argue over 95%, because 70 rooms have been taken up by the National Guard. So this is a 3-star hotel, but if you try to look on Google right now, the Staybridge Hotel Airport, Laredo, you'll find that the average daily rate is like $350 for a 3-star hotel, which is really high because there's no rooms available. The National Guard is deployed over there, by the border, and for that reason, it does really well. And then we have the Courtyard in San Antonio. This is a hotel that we're currently undertaking stabilization. It's valued around $12 million, but we believe it's going to perform a lot better and is going to do a lot better. Okay. Some of the other assets in our portfolio: McAllen Emergency Room, the Extended Stay Laredo Hotel. This one is being converted into one of the first Hyatt Suites hotels in the U.S. I've only seen one more Hyatt Suites. It's a new concept that Hyatt has introduced. And then we have some other assets, including this Optimal Recovery Spa. That's the word I was looking for earlier. And it's doing really well, and we're actually expanding this into Austin and San Antonio. And we're also in the midst of doing a ground-up development in a town called Brownsville in South Texas. It's going to include a micro hospital, and it's going to include a retail plaza. Okay, let's talk about the opportunity why we're here today and what makes us unique. So currently we're in the midst of acquiring an Aloft hotel, the Aloft by Marriott in San Antonio, at the San Antonio airport. It's a 6-minute drive from the airport. It's got shuttle service. This hotel is, we have it under contract for $10.5 million, which is way below the replacement cost. And I would even argue is way below market value. It's got 141 rooms. It was built in 2009, so it's fairly modern. There's nothing else in the market right now. I mean, we believe that this hotel is really worth about 13-14 million. We got a really good deal on it because it was a distressed sale and we had to put up a little bit of our own cash, down to get the seller's attention. It's a lender that has taken over the hotel and now they're just selling it. And so the total summary, we're raising about $16 million, $16.135 million, $16,135,000. But here's a cool thing. We are not using any bank financing whatsoever. So we're doing this as a 100% equity raise. We're doing that because we're very conservative. And we believe that the rates are high. The banks are not too keen on lending right now. So we'd rather wait and see what happens. And when the rates come down in year 3, year 4, we'll refi it later on. But right now, we don't want to use any bank financing. And we'd rather pay that return to our investors. We'd rather pass on that benefit to investors rather than paying the investors, paying the bank 7-8% in interest. Okay. So this is a breakdown of what the raise is comprised of. You'll notice that there are no fees. We're not charging any acquisition fees, nothing. All of these expenses are essential. There's a property improvement plan, which has to be undertaken over 36 months. So we don't need to raise this right away. We can always raise this after the close. But $750,000 for the operational reserves, legals and closing costs, franchise fee, which is paid directly to Marriott, and 0% financing, and total raise is $16,135,000. Now let's talk about San Antonio. San Antonio is a very special city, which people often overlook. It's the 7th largest city in the country. Okay. It is the largest military city. There are 5 bases here, major bases here, and it's the primary location for the Air Force training and deployment, etc. Okay. Another cool thing about this opportunity specifically is that it's located at the San Antonio airport, which sees over 11 million passengers annually. That's a significant number. And it's going through a $2 billion expansion right now. So they're redoing the entire airport, building a new terminal, and that's going to be the main terminal going forward. So we believe we're right in the midst of opportunity. What does a summary look like for our investors? So there are 2 options to choose from. So there are some investors that want to hold long-term, and then there are some that only want to do a short-term investment. So we catered to both. Option number 1 is you can invest for 5 years, which is a pure equity model where you see distributions, preferred distributions between 8 to 10%, depending on how much you invest. Up to $500,000 is 8% preferred distribution. Over $500,000, it's 10%. Plus, there is profit sharing at any liquidity event. So when we refi or when we sell the hotel, we're going to give you more money. We're going to give you profit share on that. The second option is purely a note option, which is a straight 10% coupon payment, which is paid on a quarterly basis. Minimum investment is $50,000, but anybody that invests more than $100,000, they get that Marriott benefit, which I talked about, the discounts. And we'll talk about that now. What does that look like? And these are real screenshots that we took about 10 days ago, 2 weeks ago, around Labor Day. And you'll notice that the date is the same date here, September 2nd, September 2nd. This is the Ritz-Carlton Hotel in Laguna Niguel in California. Absolutely beautiful property. I've been there overlooking the Pacific Ocean. Lovely place. Very luxurious hotel. The standard rate is $1,172 a night for the king room. With the discount is $281. It's absolutely amazing. Okay. And this is not limited to the US. It's anywhere in the world. Another example, the W New York Times Square. The standard rate, $453. Discounted rate, $257. Okay. the London Marriott County Hall. Before discount, £542. With discount, £133. Okay, as you can see, quite amazing. So that's a little summary of what the discounts look like. If you're a frequent traveler, or even if you're not a frequent traveler, you will appreciate it. And by the way, that discount is not factored into the IRR. Okay, this is completely separate because people invest. Some people travel a lot, some people travel not very frequently, but it's uncapped. You can use it as much as you like. So this is a summary of how it works. Like I said, only for accredited investors, 2 different options. And it's all self-directed. We walk you through it. You sign up online. You sign the documents online. The fund is administered by a third party. So we are not we've maintained a separation of 2 parties. We're the asset managers, but the fund is administered by a third party, which is called Avestor. That's the name of the company. And they administer the portal and they administer the fund. All right, we're running short on time. I think it's 7:30 now. So I'm going to conclude the presentation. If you have any questions, please go ahead and let me know. And I will be happy to answer those questions for you. There is a question: what are differences between partner and investor benefits? There is, in terms of benefits, I believe you're referring to the Marriott benefit. The benefit that we pass on to investors is the MMP rate, which is called the Explorer, the Bonvoy Explorer rate. And it's what we issue. So I don't believe there is such a thing as a partner or investor benefit. But that the rate that you get with Bonvoy, and I believe that was your question. If not, please ask me again. It's the MMP, the Marriott MMP rate. When you're booking a hotel on Bonvoy.com through your Bonvoy account, you have an option of selecting the Explorer rate, special rate. You click on that, and then that's what gets you the discount. Okay. Another question we have is, can you use your IRA/401k? Yes, you can. Yes, you can, because the IRA is, you certainly can. If you have a self-directed IRA account with a custodian, all we require is, what you have to do, actually, you have to take this step, is you have to show them the PPM, the private placement memorandum, the subscription agreement, and you have to show them the deal disclosure document. And you just have to give them the wiring instructions, and they can, you just sign the documents on behalf of your IRA, and they can wire over the money. And you can, in terms of the 401k, you can also invest through your 401k. Either you can roll it into your IRA account, or I believe recently, 10 days ago, the Trump administration signed a new bill which makes it more accessible for investors to invest with their 401k. We don't know what that looks like yet because it's too new, but we know that you can definitely invest with your 401k by rolling it into the IRA account and then investing it. And I'm sure there's a way you could do it directly from your 401k, but we don't know what that looks like yet because this bill is brand new that just got passed very recently. Okay. Do we have any other questions that I can answer? Please don't be shy. I love talking, as you can see. So I'm happy to answer your questions. And one thing I will do is I will drop my my link to the calendar in the chat below, so you can schedule a call with me directly. So it's discovery.qilacapital.com. And if you like, you can schedule a call with me directly. And what I will do after this call, all the attendees that have arrived here, we have your information. I will send you an email tomorrow, and it's gonna have the webinar replay. It's gonna have some other videos, and it's gonna have a pitch deck. And if you have any other questions, you can respond to me, and we're happy to answer your questions. Are there any other questions at this time, or we will conclude very shortly? Another question we have is how much capital have you raised so far? So we have, I have to do an audit of all the commitments and soft commitments and hard commitments. We need to raise a total of $10.5 million to acquire the hotel. We have another 45 days, give or take, to do it. I believe we have raised about 35% of the required capital so far. So I would say we've raised about $3.5 million. But then we have some other big investors that are on the sideline, and we have not deposited that money yet. So that's not counting the big commitments. But everyday investors, 100, 200,000, $500,000, we've raised about $3.5 million, I would say. And we have about 45 days to do the rest. And I do want to answer one more thing. I do want to mention it that there are some people that are experts in hotels. That's all they do. They're experts in hotels, and they've reached out to us because they've seen our ads, and they have even offered to invest in the whole hotel if we take it off the fund, because they know that it's a great deal. It's 30-40% under replacement cost. It's at a 2.5 times revenue multiple. Last year, the revenue of the hotel is 4.2 million. We have it under contract for 10.5 million, and it's a Marriott brand, 141 rooms, built in 2009. So they see it's a great deal, and they've offered to fund the whole thing if we take it off the fund. But we don't want to do that. We want to bring this opportunity to as many investors as possible. We don't pressure you. If you want to invest 100,000, 50,000, we're okay with that, to build a relationship and to establish trust. Another question, are you going to email this recording? Yes, I can, and I will certainly. Tomorrow, I will send an email with the replay of this webinar. Okay. Okay. If there are any other questions, please let me know. If not, thank you so much for your time. It is 7:36 p.m., a little bit over 30 minutes, but thank you for your patience. I hope you enjoyed the webinar and the presentation. Feel free to reach out to me, and I'd love to talk to you on a one-on-one call. And we just like building new relationships and meeting new people. No pressure. And that's it. Thank you so much. Have a lovely evening, and we'll see you soon. Bye-bye.